There are quite a few software companies that have been on dominant runs as of late, and we're going to be talking about 3 of them in this video. All 3 of these stocks are growth-centric stocks, meaning a couple of things. They have high PE ratios, here at 41, but they also have really good growth recently and over the last 5 to 10 years. All these companies outperform the S&P 500 pretty dramatically. Also, all of these are larger. I'm not going for generally smaller. These are all large cap, but no Mag 7. But like I said, all these companies have performed particularly well. Oracle here is the first one we're talking about. They're up 218% over the last 5 years. S&P 500 is only up 90%. If we go to the all-time chart since late 2015, early 2015, late 2014, they're up from about 42. S&P 500 over the last decade's up about 200%, maybe a little more when you include the dividend, but still, all these companies have absolutely swamped the S&P 500. And like I said, you do get a high PE ratio, 41. S&P 500 PE ratio is about 30, so you are a bit expensive, but considering you've more than doubled the S&P 500 performance over 5 years, 10 years, the fact that you're a bit more expensive really shouldn't be that surprising or that concerning. Forward PE is actually really pretty similar, 27.5. S&P 500 forward PE is about 24. So really, this is a company, if you're thinking about it, if you believe their forward growth, you believe their expectations, analyst expectations, you're basically buying a company a little bit more expensive than the S&P 500 that has doubled the performance. And Oracle does a lot of stuff with AI data centers and that sort of thing. So there's a lot of growth potential. I think Oracle is probably your best bang for your buck in this list, and probably out of most of these large software companies in general. ServiceNow is very interesting. They are on the upper end of PE ratios, dashboard PE ratios that I would ever quote unquote recommend. Obviously, I'm not recommending any of these. I'm introducing them, but this is towards the upper echelon of, okay, this is a bit pricey, but there's a reason, right? 5 years, 290%. So you're 3 times performing the S&P 500 performance. That is very good. If we go to the all-time chart, look at the last 10 years, you're up from 76 to 1,091. You don't have to be an expert at math to know, okay, this is a company that has done crazy well. They've done so well, and that's why I'm not recommending it. That's why I'm introducing this video. I think this is a good growth stock. 64 forward PE, S&P 500 forward PE is 24. So like I said, so you are, please understand when I say this, ServiceNow, you are paying 3 times more than the S&P 500 for a company that has basically been tripling the S&P 500 performance. They've been growing earnings per share, they've been growing revenue dramatically. This is a very large company, $225 billion market cap. If this company grows at the normal pace of a company, it will probably half just because of that. However, if they keep up growing at the rate they are, you will make money very, very quickly. This is just true. So this is at the upper echelon of growth that I would ever even show on this channel, because I don't want people being like, oh, you said this is a good stock. But please understand that this is a stock that if it stops growing at these rates, it's going to do poorly, very poorly. But if it keeps at it, you're going to do very well very quickly. So if you understand that, you're interested in that, please take note. But that's all I'm going to say on that stock. I do think it's fine if you understand what you're doing, which is, okay, it's either going to make a lot or a little. It's a high risk, high reward stock in that sense. Intuit, I just did a video on if you're more curious on it. I think this is a good long-term hold as well. 5 years hasn't been as impressive, right? 62 PE, 143%. Okay, that doesn't sound great. When you zoom out to the since 2015 10-year chart, it looks much better. Basically 650% over the last 10 years. That is very, very, very good. And you would expect that's why the PE ratio is higher. Forward PE isn't. Oh, also, yeah, I think we looked at the forward PE in there, so I think we're fine. It was 65. If we didn't. So, but yeah, 33 forward PE. So you are paying a decent premium on a company that over the last decade has gone up about triple the S&P 500 performance. So you're not paying triple PE on it. So I think this is a decent risk reward as well. Hasn't done as great over the last 5 years, but you'd expect there's still some room to grow with it. Intuit does, right, tax stuff, things similar. They have some other small business stuff as well. I think they do Credit Karma as well. Yeah, Intuit, yeah, they do Credit Karma. So they got their hands on a lot of different things. Also, all these software companies have really good margins. That's an advantage. They really get a lot of recurring revenue. You won't have crazy dips unless there's a recession that hits them specifically, but still, with higher PE growth stocks, you're going to get hit a little bit harder. If there's a recession, that's just how things happen. But all three of these stocks, Intuit included, have been doing very well over the last 5 years, over the last 10 years. Their PE ratios, except for ServiceNow, really are not that expensive, at least compared to the S&P 500. They've either doubled, tripled the performance, and they aren't quite double or triple the PE ratio. You're kind of trying to find risk reward. I'm trying to lay that out in these videos. I think most of these, except for this one, have a really good risk reward. ServiceNow does have a risk reward that can be very high, but it's definitely more swinging for the fences. But anyways, I've covered all of what I want to in these videos. If you enjoyed, I'd appreciate it if you like or subscribe. I do daily stock content on this channel, and I do videos where I cover 2 or 3 stocks that fit into a certain category, probably every other day. But I appreciate all of you for watching. I hope to catch you in a future video. Thanks for watching.